Before we dive into new material, I want to take a little time to reconnect with something you already know well, the accounting cycle and the financial statements. Think of this as a warm-up. We're not going to reteach the whole first course. Instead, we're going to walk back through the big picture. How does a transaction become a journal entry? How that entry flows through the cycle, and how it all lands in the financial statements that tell a company's story. Here's the question I want you to keep in mind for the next few minutes. How does a single transaction ripple through a company's accounts? That is really the heart of accounting. We don't just record transactions to fill up a ledger. We record them so that at the end of the period, we can report on what happened and ultimately communicate how the business is doing. Without good record keeping, a company won't know whether they're doing well or if they're on the brink of bankruptcy. Most of us are used to looking at our checking account balance online to make sure we've got enough money to pay our bills. Often we can do this mentally, but for a business to survive, that's just not going to cut it. A positive balance in the checking account doesn't tell us how much money we've made, how much we might owe, or whether we need to do something different. We need a better system than that. Accounting is a system, and like any good system, every piece connects to every other piece. When you understand those connections, the rules stop feeling like a list to memorize and start feeling like a logical structure. Let's begin with a quick review of some vocabulary that might be useful when we work through an example and visualize the big picture. Every accounting period, we repeat the same sequence of steps. We call this the accounting cycle. First, we analyze each transaction to figure out what accounts were affected and how. Second, we journalize. We record the transaction as a journal entry with debits and credits. Third, we post those entries to the ledger so each account collects all of its activity in one place. And from there, we prepare an unadjusted trial balance to check that debits still equal credits. Then we record adjusting entries, and this is the step that trips people up the most, so we're going to spend real time on this term. Adjusting entries make sure revenues and expenses land in the right period, even when cash moves at a different time. After adjustments, we prepare an adjusted trial balance, and from that, we build the financial statements. Now, this process usually happens fairly automatically in an accounting software, but it's important to understand what's happening behind the scenes. Because finally, we close the books. We zero out the temporary accounts so we're ready to start the next period fresh. Notice that this is a cycle. We do it again and again and again, period after period. The mechanics become second nature, which is exactly what we want, because it frees up your mind to focus on the harder judgment calls. Underneath all of this is one relationship that never breaks. Assets equal liabilities plus equity. This is the accounting equation, and it holds true after every single transaction we record. If you ever post an entry and the equation no longer balances, you know you did something wrong. In Financial Accounting 1, we spent most of our time on the left side of this equation. We worked our way down the balance sheet, cash, receivables, inventory, property, plant, and equipment. And in Financial Accounting 2, we're going to shift our attention to the right side. How do companies finance themselves? Through liabilities, borrowing, and through equity. This week, we begin with current liabilities, which is a natural bridge between the two courses. Now, let's talk about where all those journal entries end up, the 4 financial statements. The income statement reports revenues minus expenses to arrive at net income for the period. The statement of shareholders' equity takes beginning equity, adds net income, subtracts dividends, and gives us ending equity. The balance sheet is a snapshot at a point in time showing that assets equal liabilities plus equity, and the statement of cash flows explains why cash changed during the period, broken into operating, investing, and financing activities. But here's the part I really want you to understand. These statements are simply a formal presentation of the numbers we've been keeping track of all year. The balance sheet is just an organized presentation of the balances in all of our accounts. What do we have, and who does it belong to? It's not incredibly detailed. For example, we're going to take all the accounts and add up the dollar value of all our different products and present one number for inventory. We'll also add up any loans we've taken out or bills we haven't paid and showed them summed up under liabilities. And whenever we make money by earning revenue or spend money to pay our bills, we're just going to present one number for retained earnings, rather than detailing out all the different sources of revenue and expense. The rest of the financial statements, that's where we can see some of the detail that was lost when we added everything together. Interested in how much revenue came from just this year and what costs we had to incur to generate it? Looking at retained earnings on the balance sheet won't be very helpful. Check out the income statement for the detail. Need to know what actually happened in the bank accounts during the year? Check the statement of cash flows. Interested in how much of the resources belong to owners because they earned it or because they contributed it to begin with? Look no further than the statement of stockholders' equity. Each of these statements is like taking a magnifying glass to part of the balance sheet, zooming in on one of the numbers there to see the detail. The financial statements are not 4 separate documents. They are deeply connected. The connection between the financial statements really begins with the balance sheet, and the balance sheet is best represented by the accounting equation. The balance sheet is often considered or thought of as the balance sheet because we think it must balance. Assets must equal liabilities plus equity. But really, the balance sheet is called the balance sheet because it is a listing of all of our accounts and their balances at the end of the year or at the end of the period. So if you think about when you start a business, if you were to start a business, the very first thing that you would want to do is make a list of all of the things that you have to make money. So resources are the most important thing that we need to keep track of. We need to make a list of all of our resources. That might include cash. It might include accounts receivable, what people owe us. It might include inventory or fixed assets like property, plant, and equipment, and other types of assets. Now, the next most important thing that we would want to do is keep a list of who those resources belong to. Did we borrow them from somewhere? So they belong to the bank, potentially, or a supplier, any type of creditor. So we can get resources by borrowing them. We can borrow capital. Capital is a synonym for the word resources. Now, the other way we can get resources, we can get cash, is we can have owners that contribute that capital, and they would then have claim to it. So who has claim to our resources? Either the bank or whoever we borrowed it from, or the owners can claim those resources. So owners can claim the resources because they contributed it to begin with. And this is where we get common stock from, right? So the common stock account represents contributed capital. That means that the owner of the business put their own money into the bank account, and in exchange, they got a piece of paper that says they own the business. So any capital that they put into that bank account is a resource that they can claim. It wasn't borrowed from anywhere else. The other way, the third way that a company can get capital is by earning it. And the way that we earn our capital, and we call this retained earnings, is we use our resources. We use our resources to generate more income. We sell our inventory. We use our fixed assets to make more inventory or to package and ship inventory. Accounts receivable represents money that's owed to us because we sold our product or our service. So that's how you can think of the balance sheet. It is a list of the resources that we have and who can claim them, non-owners or owners. Now, the other financial statements are interrelated because if you were to look at the balance sheet, it's going to give you one number for cash. It's going to give you one number for inventory. And it's also only going to report the ending balance in retained earnings. But what happened in retained earnings since the beginning of the company? Well, every time we made money, we recorded revenue. And every time we spent money to pay a bill, we recorded an expense. And that's since the beginning of time. But when we look at the balance sheet, all we can see is this one number. So we might need to know, how did the company perform just this year, which means I want to know the revenues and the expenses that happened just this year. So I'm going to take a magnifying glass to that. And when I do that, I'm going to zoom in on the revenues and expenses just for this year, and that is going to be my income statement. So the balance sheet is often thought of as a snapshot at one point in time, so as of a particular date, like December 31st, but the income statement is thought of as showing me all of the revenues minus the expenses equals net income for a period of time, usually 1 year or a quarter. So that's what the balance sheet shows me. The statement of stockholders' equity is a way of double-clicking on equity, zooming in on equity and seeing, where did we start with our contributed capital? How much common stock do we have outstanding? And where did we start with retained earnings at the beginning of the year? And then what happened? What went in and out the door? Did we issue more stock? Did we purchase any stock? Did we pay any dividends? Or did we have any revenues and expenses during the year, some net income that we reported? That would show up in the detail of the statement of stockholders' equity. And it's essentially a roll forward from the beginning of the balance of those accounts to the ending balance. It gives me the detail. And then finally, if I'm looking over here at my assets, cash is really important because if I don't have enough cash on hand to pay my bills when they become due, I'm going to be in trouble. So the statement of cash flows is like double clicking here on this cash balance, and it's going to show me, where did I start the beginning balance and what were all of the ins and outs, the positives and negatives, in 3 different categories. Operating, which is going to be all of the cash flows that helped us make money. Investing, which is likely things that we did to promote growth in our organization, or financing, which involves borrowing or paying back funds. We're going to separate out all the positives and the negatives into these 3 categories, and then we're going to show how that got us to the ending balance of cash. So it's like double clicking on this number on the balance sheet and having it expand and show us all of that detail, the statement of cash flows. So each of the financial statements is zooming in on a different part of the balance sheet, either retained earnings, equity as a whole, or cash. So let's recap. The accounting cycle turns raw transactions into financial statements through the same repeatable steps every period. The accounting equation, assets equals liabilities plus equity, stays in balance after every entry and really represents the balance sheet. The four financial statements are interconnected, so a single transaction will ripple through all of them, and they all connect and give more detail about the balance sheet at the heart of all of it. And in this course, we're going to be turning our attention to the right side of the equation for liabilities and equity.